Hi, I'm Lester Bryant. Welcome to part 6 of the Doom and Logic series. In this one we're going to take a look at the business sector and a few sectors in particular, also the probability of inflation and how it might affect us. So we've been through a period of close down and there's been international disruption in supply chains. So everyone has lost ground and everyone now wants to catch up. This need to catch up is also partly driven by increased expenses. There's a general need to increase prices as well, driven by the increased expenses. Before I go any further, I just want to bring in the notion of a death spiral, or in this case, an inflation-driven death spiral. And what I'm going to do is take you through a range of information that might bring you to that conclusion. COVID-19 has brought about massive disruption all over the world. And most of the products that we buy on a daily basis come from manufacturers set up around the world, a lot of them based out of China. So now the manufacturers are looking at what's gone on and they're saying to themselves, we need to be in catch-up mode. So it's obvious that as they start to sell new products to us, we're going to see those products go up in price. And from that point of view, it's also going to cause our wholesalers and distributors to increase their restock price. If they were to retain margins at what they were before, then we're going to see an increase in the retail price. It's unlikely that we won't see increases in the retail price. Along with that, transportation around the world and logistics has decreased quite dramatically. So a lot of freight that was moved by planes cannot be moved that way anymore. We've also got a disruption in shipping. So what we're going to see is the restock velocity, or the speed of restocking these companies, is going to decrease. And they'll have to adjust by increasing the amount they purchase and the amount of storage they do. Just-in-time management for restocking becomes less relevant in a market like that, and all of these minor issues become a big issue when it comes to retail price. Retail prices have to go up. So if we conclude that retail prices will go up, and we also know that GDP is going down, you can refer to part 1 of these videos to find that information, then what we start to see is inflation trending up. And as soon as we get that, the Reserve Bank is commissioned to do one task, and that's control inflation. How are they going to do that? Well, they'll increase the overnight interest rates. And that's going to drive interest rates on things like mortgages and loans up as well. We also have a government that's trying to get more money because it's just spent a lot more and it has a lot more need to spend. So what it's going to do is increase our taxes. And along with that, we're going to see people going, I'm taking home less. I can't afford my mortgage. I can't afford my rates. I can't afford my daily costs of living. And there's going to be a lot of pressure from people who have been occupationally dormant and not driving for wage increases. Out of necessity, people will start to ask for more wages. They just won't be able to live on what they're earning. So that's then going to drive up costs even further. And very soon we have the death spiral, where all of these are self-fulfilling and increasing each other. And that brings about tension between the voters, the government, the banks, and the businesses. If we all accept that this is inevitable, then it becomes a question of when will the prices go up. In the early stages, by that I mean just past the lockdown stage, we'll see a period of unbalanced trading where people are trying to get money out of a system that's broken, where people will drop their prices until they realise that's not helping, where people are scrambling for work and then have cash flow necessity, and that'll be followed by a period of finding equilibrium. Now at this point in time, people will no longer drop their prices because that has no relevance. They can only increase their price, but there'll still be a struggle to survive. And eventually there'll be some balance in the system, and we'll see the long game, where everyone who survived manages to get what they need to fit into a sort of new economic market. So each business sector will go through a period of unbalanced trading, then they'll have a period of finding their equilibrium, and then they'll hit the long game. And if we took one example, let's say builders, and we said, okay, initially they've got their work to complete, so their prices will be roughly the same. Then they're going to struggle to find enough work, and they'll be in a very competitive market where there's too much supply and not enough demand. And that'll drive prices down rapidly as a number of companies try to survive. Eventually they'll hit a point where some of them are falling over, and then that'll rush to a lot of them falling over, and there'll be a period of equilibrium where they all realise they have to increase their prices, but they're not sure how much to. In that stage, even more will fall over, but the ones that survive will then end up in a sustained period of growth and sustained profitability. So it becomes a question of how many months to go through each of these phases for each business sector. So if we have a period of unbalanced trading, how long does that last? If we have a period of finding equilibrium, how long does that last? And if we have a long game where everything is higher than before and we know everyone survives, how long before we hit that point in time? We can look at it this way. There's going to be a period of time where things might be the same price. There's going to be a period of time where things will be less or down in price. And there's going to be a stage where we suddenly hit an upward move in the price. So we start to try to predict how this will affect each sector. If we think about retail, that's where you buy clothes, shoes, even food, entertainment, things like that. And what we'll see is there will be an initial stage of probably the sameness or a bit of discounting to attract people back in the stores. But then they're going to realise that there's too much supply and not enough demand because people have a reduced cash flow. So we're going to see a downward movement in prices, possibly from a big step down first, and then we're going to see a slow but progressive consolidation in the market until they eventually hit their equilibrium and higher prices. If we consider hospitality, well, they've had the single biggest disruption. Hospitality, international travel, tourism and international students have all dropped dramatically. So what we see here is a total decline in the tourists, and that's a 100% decline. But over a year, if we annualise this, then we're probably going to see some return. I think you're going to see, however, a long and determined period of down, and then start to come up. I already know of a hotel that is charging $238 a week for its rooms because it can't get any tourism and it's trying to replace it with renters. If you think about construction, well, a lot of projects were dependent on the tourist sector. The building industry has had a really big impact on it because of the tourist sector and the international sector suddenly disappearing. A lot of projects were in place for hotels, motels, casinos, conference centres. They've gone. Airport extensions, airport work, that's gone. A lot of infrastructure work is now not required. And this has an impact on how many houses we need, how many professionals are immigrating to New Zealand, and also things like Airbnb have an effect on how much construction goes on. Right now, that industry is on the cusp of a major decline. It'll complete its current projects and then there'll suddenly be a decline and there'll be an oversupply, and of course there's going to be a large attrition in the industry before they start to realise they have to increase their prices and become profitable for the long term. The very large projects no longer have commercial viability. So any of the projects that's a long way along the path may be completed, but it's unlikely any of the others will come on tap. So we're going to see a big decline in that market, and it's logical that we have an oversupply as well. When it comes to public service, particularly the services provided by the council, there is a lot of product that's supplied by them that is no longer required, certainly in the volumes it was before, with the decline in the construction sector. So compliance issues become less relevant. But councils are notorious for not laying off people, so we're probably going to see the same prices tapering off to lower prices over the long term. However, when it comes to the government sector, it's very difficult in a democratic regime for government to lay off doctors, nurses, police, so we're probably going to see much of the sameness along that path. When it comes to professional services, however, that game is very different. What we've got is lawyers, accountants, civil engineers, structural engineers, and many other professionals who are partially or totally dependent on thriving businesses and or construction. There'll be a lot less demand in those sectors almost immediately, and there's also going to be a difficulty for them to even get the money in that they're already owed from recent work. Those sectors are going to lay off staff to compensate for their reduced cash flow, which in turn is going to cause them to create their own competition as the people they had working for them discover they need to go out and start their own businesses. Now those businesses can be more of a cottage industry and a lower cost model, which puts pressure on those prices and lowers them down and down. It is unlikely for the professional service sector to do very well for a long time. Because transportation has been very cheap for a long time, it's unlikely that the transport sector in itself could afford to lower its prices. It's more likely there will be a consolidation to the more efficient operators, and that they will find, as less and less of them evolve, that they'll be able to progressively increase their prices and increase their margin. So what we can see from this is that the low volume, high dollar costs remain similar, but there is less money to go around. So the high volume, mass employment areas increase in price, and overall inflation will start to appear in our market. Now, another important thing to factor into all of this is how many of these businesses will survive. Do we need as many as we had before? Because of the lack of spare spending money that people now have, it's unlikely that retail will do as well in the long term as it used to. We can conclude from this that there's probably going to be a 30 to 40% decline in the retail sector. On top of that, we already know that tourism's gone, and that the hospitality sector is struggling enormously right now. Yes, there'll be some domestic tourism. If we look at hospitality as an annualised figure, it's unlikely to be above 30% of what it was before. And when it comes to builders, well, we'll have an oversupply and far less work. It is unlikely that that will be any more than 50% of what it was before. Large construction will suffer enormously, and it's doubtful we'll need 10% of the projects we had going before. Local body government and the public service, well, it's unlikely that that's going to be much more than 50% in the long run. And the government service, well, it's unlikely the government's going to lay off many of those employees. That leaves us with the professional service sector, where there will be an enormous reduction in the volume of work required, and the transportation of goods won't be anywhere near what it was before, so we'll see at least 40% decline in that market. All of this relates to the total number of companies that survive at the equilibrium stage. We can anticipate that less companies will survive, and until there's a point of equilibrium, we won't start to see those companies that do survive thrive, but ultimately if they do survive, then they've got much better chances of getting a better margin later on in the process. This could take at least 2 years for some sectors, so what we can say is the number of companies that will survive at the point of equilibrium will be a lot less. Back to what I was discussing earlier, we know that these sectors will have pressure on them to increase their prices. In other words, most of our economy will increase its prices, and this ultimately causes inflation. And that, unfortunately, also causes interest rates to hike. Inflation is a paradigm that many people haven't seen for a number of decades. In fact, there's probably been 3 decades of overall stability. Most people have long forgotten things like long-term unemployment, interest rates above 5%, and even the prospect of hyperinflation, strikes, people joining unions, asset value collapses, price freezes, inflation. These are all unfamiliar territory for many of the people who are currently working today. I'm not saying that all of these will occur wildly and out of control, but they will occur. There is no doubt that competing interests will create tension between all of the parties. People haven't experienced these things for many years, and a lot of people don't even know what they really mean. We're going to go from a stage where we have an abundance mentality, where we all assume that the pie is getting bigger, that the market is getting bigger, that GDP is getting better, and that employment is getting better, and all of the careers we've been working hard towards have meaning. But we've just had a new reality, in fact a complete check on our reality, where the pie suddenly got smaller. GDP is smaller, therefore business is smaller. And we're going to go from an abundance mentality to a scarcity mentality. We know that the pie has got smaller, the GDP has dropped. So it becomes a question of who now gets no slice of the pie at all. It also becomes a question of who fights over the reduced parts of the pie. And by that, in each sector, there will be lots of competition to get the money that remains in that sector. So if you're fighting over your slice of the pie and you're in business, who wins those fights? And if you're a mortgage holder, who wins in that situation, who loses in that situation as well? So I want to go back to my original question, who would collapse first in New Zealand? Well, the business sector is already collapsing. And the small to medium enterprise, the business owners, have secured loans with personal guarantees. If with everything else they have to deal with, we now increase the interest rates that they have to pay, will we see a spiral and out of control effect on the business sector? This also brings about tension between the banks and the government. And I want to discuss that in the next part, part 7, where we're going to take a closer look at inflation and mortgages. I'd encourage you to subscribe or like us so that you don't miss that video. If you know anyone that wants to survive this upcoming period, then please make them aware that at Labour 8 we have a free offering that looks at restructure and redundancies, and that will help them to decide what they should do at this point in time. In a way, it helps you to analyse your business now and make some hard decisions. Occasionally, not always, but occasionally, you have to cut your hand off to save your arm. If you want to see the earlier videos, please subscribe to us either on YouTube or go to LinkedIn. And for those of you that want to see where the opportunities lie out of this, go to our Business Futurist group and seek an invitation. Lastly, I look forward to seeing you at part 7. And once again, I repeat that if you haven't caught up on the earlier ones, please go back and watch those videos as well. Thank you. I'm Lester Bryant.